All right, now on to the story. Consumers may be faced with higher interest rates as much as of today. Analysts are divided on whether the Reserve Bank will start hiking rates from record lows. The Monetary Policy Committee will announce its decision this afternoon. And eNCA business editor Devan Murugan joins us now live to tell us a bit more. So, Devan, the Reserve Bank has been able to basically assist cash-strapped consumers for 2 years now. Do we expect this to happen again today or not?
Oh, well, that's the big question, and I got to tell you, for the first time in a very long time, economists are divided on this one. If we do see a rate increase, it might be about 0.25%. You might think that's small, but considering the huge cuts, it can take away money from your wallet. So here's what we've been basically receiving from the Reserve Bank over the last 2 years. Interest rate cuts quite extensively to bring us to these figures, which we'll bring up in a moment now. The repo rate currently standing at 3.5%, and the prime rate at banks, which is specifically related or concerned to consumers, is 7%. Some economists, as I said, expect that rate to now increase by 0.25%, which means interests on loans do go up. So, 3.5%, as I said, are multi-decade lows, and it's about time, some economists say, that we start normalizing those rates, and that could go up, and as a consequence, the prime rate you pay at Bank Masego will actually go up from 7%. That's if the MPC from the Reserve Bank decides to go that way and hike.
So obviously if the cycle goes upwards, then consumers have a lot to adjust to. I mean, 2 years of a repo rate remaining unchanged, and suddenly it goes upwards.
Yeah, although the Reserve Bank, Masego, will argue that, look, given the magnitude of the rate cuts, going up by another 0.25% might not be that traumatic for a consumer. Nevertheless, you're quite right to say that the trajectory is now upwards. You've got to start your belt tightening. And let's just quickly take a look to see what the Reserve Bank has done since January last year. You'll see that the bank aggressively cut the repo rate at 1.6.5%, and then right down to where we stand at the moment, to 3.5%. It basically stayed steady around about June, July last year. This is all in support of the economy and to cushion that impact of COVID-19. It was unprecedented, as I said, and had the bank not done this, then the economy would arguably in a much worse off shape. That record low rate was capped there, as I said, since July last year. But low rates, this is one important consequence of low rates. They affect the rand. The rand weakens partly as a result of investors chasing higher rates elsewhere in the world. So when that happens, and you'll find that the investors, just like a consumer would approach a bank, goes to those countries with higher rates, the rand tends to weaken. And when the rand weakens, we could see inflation rising up again. So inevitable that this would happen. Rates will start normalizing, but you could see, if it stays this way, the rand remaining weaker, and that ultimately affects inflation, Masego. So that's one of the things that the Reserve Bank ponders on.
So, Devan, in terms of the Reserve Bank making a decision on the repo rate, what are some of the things that they'd ordinarily consider?
The first thing they look at is whether or not inflation, price rises are getting worse. Now, I need not tell you, you've done a couple of interviews on the fact that food prices are going up, petrol prices are going up. What is that? That's basically inflation. When the Reserve Bank sees that happening, they tend to support a rate hike just to stabilize the currency. And by the looks of things, inflation is going up. So that's why some economists say, well, you're likely to see a rate hike. We'll know, of course, at 3 p.m. in the afternoon.
But of course, just in layman's terms, if you're a person who, you and I were having that conversation earlier off air, if you have a person who in January last year took out a loan of R1 million maybe for a home, what has this unchanged repo rate meant for them? And if they do take it lower, what would happen to the country?
Well, it's interesting, and it's this part of the graph that's essential to your question here. If you had R1 million loan, depending on your terms, by April that year, that was the COVID year, the contributions you have made on your loan repayments would have substantially dropped. I mean, by 3%, that's huge. And the consumer kind of got used to that payment right through up until now. All of a sudden, you see the projection in this part of the year starts going up. So we assume that the Reserve Bank will take that approach. It simply means that that loan repayment that you were used to all of this time starts swelling. So we've got to consider that.
Well, Devan, thank you very much for breaking that down for us. I think I'll see you at around 1 o'clock for more of this breakdown.
Indeed.
Thank you very much. That's eNCA business editor Devan Murugan.